Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Baytex Energy stock so we can determine if it's a buy or a sell. Baytex Energy is engaged in the acquisition, development, and production of crude oil and natural gas. It operates in the Western Canadian Sedimentary Basin and also in the Eagle Ford in the US. The company is headquartered in Calgary, Alberta, Canada, and was founded in 1993. Let's get started with the model. This is a mid-cap company, 2.8 billion market cap. They're trading at $5.10 a share, and they have 545 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow dropped a lot from 2019 to 2020, mainly due to COVID. Revenue dropped a lot as well. But it jumped up in 2021 to 400 million, even higher in 2022 to 650 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. Looks like they had a lot of write-offs in 2020. They reported a loss of 2.4 billion. It looks healthy in 2021 at 1.6 billion. It drops to 856 million in 2022. Revenue is a sales for the company, and that drops a lot from 2019 to 2020. Then in 2021, it's almost exactly what it was in 2019, but they had the best year in 2022, 2.9 billion Canadian dollars. We're looking at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's look at the capital structure. 3 billion of equity, 900 million of debt. They're 76% equity, 24% debt. And they have a really high WACC, 15.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 6.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.2 billion. We divide that by 545 million shares. And we get a calculated stock price of $9.50. They're trading at $5, so they're trading at a 46% discount. It's a really strong buy according to the model. Simply Wall Street is even higher than me. They're at $27. They're saying it's 81% undervalued. 10 analysts priced this stock, and the average price target is $7.53. So they're saying it's 48% undervalued. This is where the stock has been trading since 2002. It was over $50 a share back in 2010, 2011, and part of 2012. It looks like it peaked at close to $60, but then it really crashed in mid-2015. It fell below $10 and it never got above that point. It looks like it got as low as $3 during COVID. And it looks like they were paying a dividend up through the third quarter of 2015, but they haven't paid one since then. There are 81 companies in the same industry as Baytex. Most companies in the oil and gas industry pay a dividend. They do not, because they can't afford it at this point. But I think that may change this year. It looks like they're bringing in a good amount of free cash flow. They rank 39th in market cap of the 81 companies. The median is 1.8 billion. They're 2.8 billion. I converted all these numbers to Canadian dollars, and they have really good price multiples. A price to book below 1, a PE of 3.2. Look at that price to free cash flow, 4.3. That means their market cap is 4.3 times higher than their annual free cash flow. Price to sales of 1, a price to sales of 1, that means their revenue pretty much equals their market cap. So to summarize, I have them trading at a 46% discount. I rank their free cash flows and revenue 8 out of 10. Their ratio is 9 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.